Hey folks, Dan Frio here from the the rate update. I apologize. We had some issues with our broadcast, so we had to recreate another channel, but we are back. So today what we're going to talk about is debunking the fact of non-QM mortgages. But what everybody keeps continuing to think is non-QM mortgages are the subprime of old. So let me put this all into context. Subprime mortgages, we all know, and if you watch my channel most often, is you know that it was the culprit that basically would crash the world back in the early 2000s, and would cause the world basically to end in 2010. So there's all products keep coming out with mortgages, but if you're out there and you're self-employed, or if you're an investor, or if you're a foreign national, you're going to have a lot of trouble getting financing with your home. So what we're going to talk about today with Jamie, he's a non-QM lender, and we want to debunk what is a non-QM mortgage, because what we don't want to do is confuse that with the subprime mortgages of old. So thanks, Jamie. Let's try this again. Somebody's going to watch that last video and say, "Ooh, this is like deja vu." So yeah. Jamie, thanks again. Sorry for taking the thunder out of you last time, but tell everybody a little bit about yourself. And then we're going to dive into the non-QM program so people get it. And if you're out there and you're struggling to get a mortgage, maybe this is your fit. So thanks for joining us again, Jamie.
No worries, Dan. Thanks again for having me.
All right. Yep. I hate to say it again, but if you would reintroduce yourself to the audience. And the guys, why I'm saying that is we tried to do this about 10 minutes ago and had technical difficulty, and we are back. So thanks, Jamie, for joining us. So go ahead. The platform is yours, bud.
Thank you. My name is Jamie Gill. So I've been in the mortgage space for about 25 years. Been fortunate enough to work throughout the U.S. and Canada in a variety of capacities. For the last 3 years plus, I've been involved in the non-QM space of the business, as Dan referenced. Non-QM loans, or non-qualified mortgages, are basically loans that don't quite fit the underwriting standards of a Fannie Mae or Freddie Mac or an FHA, for example. Does not mean they are necessarily a bad credit risk, because they are not, as history has shown so far. So I'll jump in, Dan, to the non-QM versus subprime piece. And sure. I think a lot of it is really the nomenclature. It can get confusing if you don't know the business. But these are strikingly different loans. And I'll touch on 4 key metrics based on securitizations that we've done in the non-QM side since 2015. I'll start with the average FICO. Today's non-QM space provides an average FICO of around 730, which, as you know, is very strong credit. Yes. In comparison, the old subprime days, it was common for the average FICO to be below 600 or low 600. So
that's where I met you, in the subprime days back in 2006.
Yeah, in Chicago. Yeah.
Yes, sir.
I still miss Portillo's. Yeah. So average LTV in the non-QM space is currently around 70%, meaning most people have about 30% equity in their home. That's a very strong position. In contrast, as you know, in the subprime days, much of that business was over 90% LTV, and in much cases, 100% LTV, meaning no equity. So striking contrast there. People are more prone to stay in the home when they've got that much skin in the game. So another interesting part is about 65% of non-QM production is in the purchase side of the market, whereas in the old days, so again, people buying homes with good money down, whereas in the old days, much of the subprime market was a cash out refi. And based on the LTV position, when they did buy, there was little or no money down.
Right.
And lastly, interestingly enough, still about half to 60% of the borrowers in non-QM are self-employed. The main difference nowadays is we make them prove their income via a variety of different documents or ways, as opposed to the old stated income loans that we heard so much about from the past. So when you take those 4 points and add them up, you've got really self-employed borrowers, successful business people, been around a while, good credit, good down payment, skin in the game. They want to buy a house, and due to the taking advantage of the U.S. tax laws, they may not qualify for traditional standards.
So what's your normal client? Because if you look at this, it's like, okay, they have great credit.
Sure.
They have money down because the LTV is 70%. So they're putting down 30% or something in that realm. So why the backdrop? Why wouldn't that person not go with just a standard conventional or like an FHA or VA loan?
Sure. One of the biggest culprits is the income piece. And again, particularly for your self-employed borrower. We all know these folks. They're very successful. Contractors, plumbers, electricians, consultants. They use a lot of different materials. They might have a lot of trucks. They have good accountants. They take advantage of U.S. tax laws. So their final tax return, their adjusted gross income, as we call it, may not really signify their true cash flow. One of the biggest examples would be depreciation. If you're a successful contractor and have 5 trucks and a bunch of equipment, you're depreciating all that on paper. However, that's not a true reflection of your actual cash flow that you live with month to month. As a result, you may not qualify for the house you want. So, put yourself in the position of those business owners. They've done everything right. They've worked extremely hard. They've managed their money. They've saved. They've taken the calls at midnight from their customers, all the stuff that we all do in business. Yeah. And they either want to buy the first house or they want to upgrade because they've had a business now for 5 or 10 years. And it's frustrating for them because, they've done everything right.
Sure. One of the first loans I did as a non-QM, I didn't even really know what it was. I wasn't in that space for a long time, but the first loan we did was actually a logistics person who owned a bunch of trucks, and you hit it right on the head. You made it an example. And guys, I didn't set this up. We got his tax returns, and his bank statements show the guy makes like $200,000 a month. And it was legit. The guy owns multiple properties and Bitcoin and huge portfolios and everything. But when you dissect his taxes, it was like, the guy doesn't have 2 pennies to rub together. So how do we get this done? And that was the perfect example of that. There's another program that's out there that's hot right now that we had. Basically, I did a video on it, and then we had a flood of new loans coming in. It was called the DSCR. Can you kind of go over the backdrop of that and the guidelines for those out there that are investors? It's like, hey, that might fit my realm.
Sure. So DSCR is specifically and only for the real estate investor. It's for an investment property or what we call a business purpose loan. Some folks want to get into that business. It's a very lucrative business. Some are very successful at it and own dozens or more properties. DSCR stands for a debt service coverage ratio. And what that means is we're going to qualify the income piece of this loan based strictly on, does the property cash flow? Acronyms aside and all those things. Does the property pay for itself? And so to put it, to give you an easy example, you buy a 3-unit rental property and each unit rents for $1,000. Your total gross rental is $3,000 a month. And your mortgage, taxes, and insurance, all in, happen to be $3,000 a month. You always divide those two into each other, and you want it to be at least flat or 1%, meaning, to your point, it pays for itself. It's a great product. There's a lot of advantages to it because, again, your personal income or personal debts do not come into play when it comes to qualifying. There's no limit to how many properties one person can own. You're allowed to do these transactions in an LLC for protection.
Really?
Yes.
So how do you pull credit on that? Is it the individual's credit, but then you can put it into an LLC?
Correct.
Okay.
Yep.
What's the normal LTV? Because that's what a lot of people will look at. They'll say, well, yeah, that's a great product, but I need to bring 50% of the down payment. I might as well just try to pay cash if I can.
Fair enough.
What sure. Loan to value can you go? And is there increments? If, for example, normally on a single family home, you can get this. And then as you go up to 4 or 5 units and so forth, that dramatically drops.
Sure.
So can you go over those details?
Absolutely. So you've got minimum FICO scores, probably somewhere in the mid 6s. And that, of course, will play a role in how much money down, as well as the property type. So on a single family, you could get as little as 20% down or 80 LTV based on the property and the credit.
Really? With the DSCR program?
Yes. Yeah.
Interesting. Because that's basically where you're at on a conventional loan.
Correct.
Okay.
With a lot less paperwork.
A lot less paperwork.
With the pricing adjustments today's world on conventional loans for investment properties, you're not going to see, much spread there. The other thing is on a multi, say 3 to 4 unit, 25% down.
Okay.
So still not in some cases, maybe 20% based on the property and the borrower. So not a stretch, not 50%. Another nice piece about that product, Dan, is the true investors will love this. You can use an interest-only payment.
So does that program also have the 40-year?
It does. It does.
So that's where we're getting. I keep hearing all the time, there's a 40-year mortgage out there. There's a 40-year mortgage out there. And I'm like, the only thing I can think of it's in the non-QM sphere because you still can't do it on a conventional loan. So can you couple it with this, with to maximize your cash flow? Can you do a 40-year interest only?
Yes.
Or am I asking too much?
No, that 40-year is the interest-only piece. So what we have is, for the first 10 years, you have an interest-only payment with a fixed rate. Got it. 10 years, fixed rate, interest-only payment. After 10 years, if you held it that long, the rate would stay the same. it automatically converts to a 30-year amortized product. So
Pretty
there's
cool.
no, to your point, a huge difference from the old subprime loans. These are not teaser rates. There's no major adjustments. It's not negative AM. So
Good
you have
point.
no downside risk. If you held it for that long, your rate won't adjust. It's really nice. And as you know, investors live off of cash flow of their properties.
Right.
Interest only gives you a lower payment, higher cash flow. It may help you qualify for that DSCR ratio. You might be just under that coverage ratio of 1%, but if you went to interest only, you may not qualify.
Got it. I have an investor I spoke to recently, and he's down in Florida, and he's building a development. And he asked me about foreign nationals because he said, I think it was, and I'm going to get this wrong. It was like Portugal or so. I know that wasn't it, but he said there's a lot of money right now flowing from overseas. And I saw a video, or actually news clipping yesterday, that said there's $59 billion worth of foreign investors bought $59 billion worth of real estate last year alone. And about 40% of that was paid in cash, but that still leaves 60%. So like $30 billion worth of mortgages for foreign nationals. So can you break down the foreign national program for us, just for those out there, especially the developer that I'm speaking with, because I might get you on a phone call with him later this week.
Would love to. Sure. So foreign nationals are borrowers that specifically cannot legally live or work in the U.S. So there's no immigration standards. They don't need a certain visa. They don't need to be non-permanent resident aliens. These are strictly folks that live overseas and want to buy property in the U.S. for one of two reasons: either as an investment, because it's a pretty good market in the U.S., generally speaking, or also what we see a lot of is you'll have wealthy individuals overseas who put their children into our school districts. They love U.S. school districts, particularly in the Northeast. And rather than live in a dorm, they'll buy a condo, and
Really?
the child and maybe the wife will come over and live with them. So it's a huge market. We've done a lot of this business. To your point, it's prevalent in certain parts, all your larger markets. So a lot of Florida, the Boston area, the Chicago area, of course, California. It's a great product. Again, no legal documentation needed to be in the country in terms of visas or so forth.
Okay.
Those folks can get in with as little as 25 to 30% down based on the program. If you want to get a little crazy, Dan, we can actually mix the foreign national product with the DSCR product aforementioned.
Really?
So you've got a individual who, to your point, might live in one of the countries you mentioned, whether it's Portugal or something else, that wants to invest in U.S. real estate. There's a couple ways to underwrite that loan, but if they wanted to say put 30 or 25% down, as long as that property cash flowed like we discussed earlier, and they met the credit requirements, they'd have a loan.
Jamie, what are the credit requirements on going to be for like a foreign national program?
We're going to want to see 3 trade lines, and that takes some work, Nico, if you're not used to it.
Sure.
Not many other countries will have a credit bureau or credit reporting agency. Canada does, England does, and parts of China do. Otherwise, what we ask the borrower to do is go to their local banks or credit providers and get us 3 reference letters. Now, this could be their current housing payment could be one. They probably have some kind of credit card. Again, if you think of the complexion of the borrower who has done well enough in life to invest in overseas real estate, they probably have some banking relationships. Sure. And based on the country, HSBC, for example, they're worldwide. You can get all kinds of stuff from them. So let's build the credit file, as we used to say, Dan. And the income piece can be either DSCR or some countries you get tax returns. Assets will want to translate and convert to U.S. dollars if they're overseas. We do not require all of that to be, in the U.S. It can come over, but we have to source it. But it's a great product, especially for certain markets, and we'd love to help.
So far we've gone over in detail. We went over the DSCRs. We went over the foreign nationals. I know we get a lot of phone calls, especially in Texas, Florida, parts of California, for ITIN. Sure. Can you kind of just what isn't? I've never done an ITIN loan.
Sure.
But I get a lot of requests for it, and it's not available in the conventional world. But I know there's banks doing those type of loans. So if somebody's looking for an ITIN loan, what direction do you have a direction for us with you, or what direction should we take?
Sure. So there's definitely some capacity out there for what's called an ITIN loan. So an ITIN stands for Individual Tax Identification Number, which could be for a person or a business.
Okay.
And it's a little different than foreign national. These folks are in the U.S. They are probably self-employed or been here over 2 years working. For a variety of reasons, they need to use their tax ID number to qualify for the loan and to show their credit references. And so that gets a little challenging for some borrowers based on where they work or what their credit profile may be. But, basically folks who are trying to qualify off of that ITIN as opposed to their social security number have the ability to get loans. They can use income from bank statements. They can use income from their W-2 employer with a written VOE, Dan. And yes, to your point, in certain markets, there is a lot of that business. There's a great organization called NAREP, which, does a great job of helping these people home ownership.
Okay.
It's a good group, Nico.
I think I've been to one of their seminars in Chicago.
Yeah, absolutely.
So, Jamie, what are the other pieces of this puzzle? Because all I really knew about was I get all these solicitations in my email about get no income, no this, no that, bank statements only, all this other stuff. I try to dig into it as much as I can, but I get it where the viewers out there saying, here we go again. Here's those stated incomes and all this other stuff. You hit it on the button, though. You said, you reiterated the credit scores in your average credit scores for your loans right now are 740. I never thought that in my wildest dreams. Even in the subprime day, I think you could at 580 when the no Nina, no stated, all that stated stuff. I think it came in at like 580 was the credit scores back in those days. You can't even hardly get a mortgage today with a 580 credit score. So your average scores are 740 with a 70% loan to value. So if anybody out there, 70% loan to value means 70% of the house's value is financed. So you put down or you have 30% equity into the program. That's huge. What are the other? If you went through your top products, if you could just break them down for us, what are they?
Sure. Beyond the aforementioned bank statement loan, DSCR, for nationals, we do a lot of condos. So, as you know, Dan, Fannie and Freddie, FHA, the condo complex or project itself has to be approved, not just the individual unit that somebody wants to buy or borrow on. There's a variety of factors that can make you non-warrantable, as they say, in terms of a condominium. Some common ones might be investor concentration. Perhaps there's too many investors as opposed to people that live there as primary residents. Perhaps there's too much commercial influence. There might be some litigation or deferred maintenance. Variety of reasons. Again, does not necessarily mean that's a bad loan or bad risk. So we do a great job actually with condos, non-warrantable condos. Picture a nice high-end residence above a Four Seasons or Mandalay Bay down in the Mag Mile. That's a non-warrantable condo because it's above a hotel. The overall commercial influence is higher than it should be. Those are great properties. Yep. Those are great properties.
Yeah. I never thought of that. Yeah, you're downtown in the city and you're above, one of the big major players, Water Tower, all those places. Yeah, I wondered how they would get financing. Great point. I won't step on your toes. Keep going.
What's an LTV looking like on something like that?
Yeah.
Because I adjust the borrower up to 80, Nico, based on the borrower. Yeah.
Really?
Yes. And again, pick up a listing, look at some of the condos for sale above a Four Seasons or a Ritz. These are beautiful properties. You can live there year round. You've got a separate entrance. Top-notch borrowers buying these properties. So that's a great example of it. Another one is, I live in Rhode Island outside Boston. Boston is what we call eds and meds, right? So you have all education and all medicine up there, all hospitals. So a lot of condos have tenants, right? The investor concentration might be too high for Fannie and Freddie. Those are great tenants. Those are great buildings. Everybody, are professional folks, hardworking folks, business folks. Those are beautiful buildings. It doesn't mean that just because people rent and don't buy, that there's risk there per se. So there's another example. You might have some litigation. You might have something as simple as a slip and fall, or developer perhaps didn't finish the landscaping yet, nothing structural per se. Some of that
Okay.
stuff may kick out from Fannie and Freddie. The biggest thing in that regard, Dan, speaking of that, is after the unfortunate incident in Miami where that condo collapsed,
Yeah.
as you probably know, Fannie and Freddie really tweaked their condo guidelines and based on deferred maintenance. And it can be very strict in some cases. And so that may make it non-warrantable. So variety of things there where great properties, great borrowers, doesn't mean it's bad risk. And then you've got condo-tels, which many people won't do. Most of the condo-tels we see are in parts of Florida, Utah, Sun Valley, the nice ski areas. You've got a condo-tel, for the benefit of your listeners, is unlike a condo that you may own and live in 365 days a year. A condo-tel usually, maybe you might stay there half the year, have the ability to stay there 3 weeks out of the month. The rest of the time, you have the advantage of perhaps putting that property into the rental pool, and they'll rent it for you. Yep.
I always thought it was like you bought a room in a hotel or something. Honestly, I didn't know. That probably sounds so stupid, but I never understood what a condo-tel was. And I apologize. Jamie looks on my end. Jamie's looks a little foggy. I don't know if it's an internet connection or whatever, but your words are coming out perfect. So we're rolling with it. So if you're out there, if you're watching us right now, thank you so much for joining us. Please don't forget to give us a thumbs up. Let me know where you guys are coming from and start asking any questions. We'll let those build here for a minute because I still have some questions for Jamie. So again, Jamie, we pretty much debunked the fact that they are subprime loans. There's no negative AM loans. There's no teaser rate loans. You have to have skin in the game. The credit's good. Any other products that you see? Because I didn't know you did condo-tels, unwarranted condos. This is all new to me. Hold on. I just had a spreadsheet up of some of the products. I went to your website and I saw some of the products on there. How many units will you go up? Normal conventional financing will go to a 4-unit building. Then from there on, it's commercial. Can you go more than a 4-unit?
Currently, Dan, myself at our firm, we're capped at 4.
Okay.
Now, there are some others out there that will have a 5 to 8 unit product. So, If
in the non-QM sphere, you can go up to an 8-unit building?
Absolutely.
Okay.
Yes.
Didn't know that as well.
Yeah.
There's another thing on your website. There was a thing that had an asset depletion, and I kind of get it, but I don't get it. Can you explain that loan?
Sure. So an asset depletion is where you have somebody with a large asset base, and for whatever reason, maybe the income that they draw or use from their normal revenue streams does not qualify for the loan. So what we can do is we can assume, we don't ask them to start drawing money from the asset base. We can assume that they could draw X over, say, 120 months. So maybe we say, okay, they're going to draw 3% over 10 years. And we can add that number to the income. So I'll give you a great example.
Okay.
Got a gentleman in Connecticut, very successful, owned a large recycling business. Sold it to one of the nationals. Had $6 million in cash. You could see it. Morgan Stanley, great thing. In Connecticut, he owned a $2 million house. He was in Florida, got in a bidding war, and paid $1 million cash for a condo to get it. He had no mortgage on the Connecticut house. However, as part of his buyout, he had $6 million, but his W-2 contract, which was a very nice amount, didn't quite cover $1 million mortgage he wanted to recoup. So we were able to combine, not just use one source of income, his W-2 contract income, as well as form a stream of income off that $6 million asset base, combine those two numbers, and he now qualified. So, for example, if you had $1 million and you said, I assume 3% over 10 years, it'll give you a number if you put in any bank rate calc. It might give you $3,000 a month. I'm just completely spitballing that, Dan.
Okay, I got a dumb question.
You add it to your income.
Okay. I got a dumb question I'm going to say. So it looks like you can mix and match programs. So let me ask you this point blank. It seems like if a loan makes sense, you can kind of maneuver it through your programs to say, well, it fits the asset depletion and the DSCR. So I know it doesn't, those are two contradicting equations, but you can actually mix and blend. So is it more of a I'll say it this way, a makes sense loan that if it really makes sense, you guys will figure a way to make it work, but you have to have good credit, skin in the game, and you have to have some way of proving assets or income.
That's
right?
exactly, it's 100% right, Dan. It's,
got it. Okay. I keep thinking every time we get a client that's a little bit, off, it's like, well, it didn't fit the DSCR and it didn't fit this, so I'm dead. So we should reach out to you on basically every scenario that kind of makes sense and just run it past you to say, is it doable?
Sure.
Okay.
It's, we feel our job in the non-QM side now is that of trainers.
Yeah.
Look at yourself,
Right.
Successful career, been in the business for decades,
Yeah.
done great things. But this product line hasn't been around for years. And it's new. And quite frankly, the last few years with the refis and et cetera, it hasn't really been needed by many.
Right.
Well, it's really an education piece.
Yeah, I have people coming in here all the time, and I'm like, you know what? It's hard enough to just get normal loans done anymore. Not hard, but you know what I'm saying.
Sure.
But this can open up a whole realm of products for us. The nice piece of this puzzle was we're getting calls from people. Here's what I hate doing. I hate taking a phone call when people are reaching out to us because they watch me on here, or they check other things, looking for guidance. And then it's like, can't help you. Click. I want to at least know what's out there, even if the rate might be a little bit higher or something else, but at least be able to give them direction or a path to say, okay, here's something that could work. Yeah. Now, how are the rates wise? Are the rates sky high, or are they in the realm of kind of where rates have to be a little bit higher than where you're seeing in conventional and FHA programs because there's more risk there? It seems like it. Yeah. But are they way out of tune or way out of lockstep with conventional financing, those rates?
I would not think so. So, for example, there is on paper more risk here, to your point. The biggest thing is these loans do not get insured by the U.S. government. That's a pretty nice insurance policy to have in your back pocket, and none of these loans have that. So there's really the risk. Generally speaking, these loans could be 1 to 2 points higher than your average 30-year fixed.
Okay.
Based on the loan, the product, and the borrower. As you know, an investor loan at a higher LTV will carry a higher rate than an owner-occupied loan at a lower LTV.
Right. Yeah.
So,
and in those cases, right now, I'm seeing sometimes just like a standard conventional investment. Those rates are sometimes worse than non-QM rates.
Yes.
At this moment.
Second homes as well, gentlemen. If you look at Fannie and Freddie and when they made that adjustment. So that's a great market for us. We can do bank statement second homes. Again, you think of that same self-employed borrower, successful business. They want to buy the house near the shore, the lake house out in Wisconsin, all those things can't quite qualify, but with bank statements, they possibly can.
Got it. You look at a condo, this non-owner occupied cash out. I mean, the rate's almost 10. You can't even do those loans. So that's an avenue we can direct toward you guys. So that's fantastic. Okay, guys, I'm going to open up the floodgates here. Hopefully you joined us. The reason being is you wanted to find out more about untraditional financing to either buy or refinance a home. That's why reach out to Jamie. I knew him years ago, back when I was in the subprime business. Yes, I was in the subprime business. I let everybody know that I was a part of that equation. I saw this coming, and I saw the bad underwriting. I saw the bad standards. I even witnessed fraud. It was a mess. And it was basically, I hate to say, a cleanup. But now, everything underwriting standards are better. You're going to have people out there saying, okay, there's still bad loans out there, whatever. It is a completely different market than where we were. So if you guys are watching, please ask any questions that you have. It doesn't have to even be based on non-QM loans. If you have a question about, hey, can you do this, or what's the minimum credit score? What's my down payment? Any questions that you have, we'd like to open those floodgates up. Also, please just give us a little blip down there. Let us know where you're coming from or watching from. I'm trying to incorporate the whole country. That's why I keep moving this time a little bit further out to help those on the East or West Coast so they don't have to get up at wee hours in the morning to watch us. So if you guys would be so kind, please ask any questions that you have. Nico, if you can start going through some of these for us. And then please, guys, this is why we do the live events, and I don't do them just a regular video to explain this for you. So you can ask the experts.
All right. So young Peasy, it looks like he bought a conventional loan last year. And he also said that the Florida real estate is still on fire. So more of just
Holy
a comment.
cross! Come on, guys! You got to ask some questions. Okay, I'll keep asking. So, Jamie, there's times where we have 300-400 people on here, and the questions are lined up that I can't even get to. And then there's some times like this. We might have had a glitch too when we had to move from the other link when our YouTube link wouldn't work, so that we might have lost a lot of people there. And I apologize to you for that. Let's go over. So, a client, we get a client, we send it to you guys. How long does it take? Is it a grueling process where the like conventional financing and all that is pretty streamlined? We have all the computer systems. We have the credit report systems. We go blah, 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 run it through the thing, send it, and we're done almost to a point. On your side of the equation, is it fairly the same? We send in the loan applications and credit reports and so forth. You guys, will you pre-underwrite a file for, like, say somebody's looking to buy a property, they need a pre-approval? Can we get them pre-approved so they can go out with confidence and put a bid on a house?
Sure. Great questions. And to your point, the technology in the conforming conventional side over the last few years has been great. It really has. I mean, think about it, Dan. Property inspection waivers, tax return readers.
It's nuts.
It's, everybody deserves a lot of credit for that. Non-QM kind of being still in its infancy as an industry, we don't quite have some of that, but we have some really good technology. We've got a great front-end system that you can go on. If one of your clients calls you, you can go right to our portal with your credentials. There's a live pricing scenario right there that is backed by one of the larger pricing companies out there. You can get an instant answer based on the standard criteria that you would put in. You can then talk rates and pricing and scenario with your borrower. If you like everything and you have all your documents, you can go as far as right through online, continue to click, upload a 3.4. You can get disclosures if you want requested, enter settlement providers, all those things, and get that loan right in the setup. You can upload your docs and everything.
Awesome.
Non-QM is a little non-traditional. So to your point, I was thinking of when you talk about mixing programs, it's not uncommon to see a husband and wife and one spouse has a W-2 job, one self-employed, so you're using bank statements for one, W-2 for the other, and once in a while you might have some asset depletion mixed in the background. So those are going to be a little tough to run through, a engine with 15 drop downs. On those things, you would reach out to one office and say, listen, I've got something that's a little out of the ordinary. Thankfully, we can, to your point, make common sense loans. We can make common sense exceptions to our guidelines. We're very comfortable with credit. So if it's a clean cut, hey, I just want to get something going with this borrower, we've got that. If you need to go deeper or you need some real guidance, something, we've got that. And lastly, to your point about helping your borrowers shop for confidence, if you give us the bank statements up front on a bank statement loan, we'll do the income calc for you prior to submission, so know with confidence what your income number is.
Got it. That's the tough part, because even we get people's incomes, and it might not be as people, when you're doing your online application, most clients, they go online, you don't know, when it asks you what's your income, I kind of wouldn't even know what to put, because my income's all over the board. I get commissions, I get profits, I get this, I pull a salary, all the other stuff. So it's very difficult to do that. So if we can send that documentation to you guys to calculate it, because you calculate it, so I'm assuming you won't come back to us and say, you did it wrong because we didn't do it. So guys, what we're talking about today is loan programs that you probably never heard of, or outside the box, or maybe you have heard of them. They're called non-QM. What we wanted to do is I asked Jamie to come on here today. That's what he does for a living, but I wanted him to debunk the fact that they're not the subprime loans of old. He did that. He's basically went through it, and the credit scores, back in the day with the subprime, your average credit score is probably in the low 600s. His on the non-QM right now, he's seeing scores over 740. But there is skin in the game, and that's what he was, explaining to us on here. So if you have any questions, especially if you're a realtor, you have clients out there that are like, hey, I can't get them a loan because of this. Maybe your person that you're using for your mortgage side of the equation doesn't have access to this. I want to be your one-stop shop. That's why we stop all over the country to find people like Jamie and companies like him. So when you call us, we don't have to say, well, we only have this one product, we can't help you. We have products all over the board, and even those that make sense. Okay, so, we got some more questions. We got somebody coming in from Long Island, Courtney. I don't know if you just tried to call me, but I just was getting a phone call on myself from New York. So if you did, hopefully you left a message, and I'll call you back here shortly. Because yes, guys, I do produce, and I still work on loans. That's what I do. So next question is 580 for non-QMs. Jamie, can you even get a non-QM loan with a 580 credit score?
Not at this time, Dan.
Okay. So that one piece of the puzzle kind of debunks that they're junk loans. Okay. You don't want the credit. And I'm not saying if you have a 580 credit score, you're bad, but I'm just saying there's usually a representation there of what your credit really looks like. And again, you can get an FHA loan or a VA loan or a USDA loan with a 580, but you cannot in the non-QM sphere. And again, these are not the subprime of old. And that's the biggest reason why I asked Jamie to come on here, is to help you guys understand the differences in the loan products. Is there anything else there, Nico? If not, Jamie, what would you want to tell the borrowers here? That was it. That was the last question. Come on, guys. You can do better than that.
Jamie, I can't say that because I know I've worked with on QM loans before. Like, unlike us, when we're going by conventional FHA guidelines, we can't really make exceptions where you can go to your guys' team, right? And if something makes sense, there's circumstances or whatnot, you guys are able to make exceptions for certain scenarios, right?
Yes, that's a good question. And I'll give you an example, Nico. We see this often. Somebody works at a business and they want to buy the existing business. Or I just had one. We had an orthopedic surgeon. He worked at a firm for 8 years, $1 million in the bank, 780 FICO, beautiful borrower. He made partner 14 months ago. Technically, what is he? Self-employed, right? He no longer gets W-2. He can't get the loan because he's less than 2 years self-employed. So
here, let me put it in context real quick for somebody. Okay, so folks, if you're self-employed, the normal case is this. You have to show 2 years of federal tax returns so we can figure out how much income you have. So you could have worked at that company for years. You could have been the number one salesman making $1 million a year, but now you bought the business. Okay, so now technically you're a business owner and you just became a business owner and have millions of dollars. You can't use that income because you are not allowed to use it because now you own the business. You're not an employee. So that's basically, I'm sorry about that. I try to put it in as layman's terms as easy as I can to explain to everybody the nuances behind that. So that in turn, that person could get a non-QM loan, get in that loan to get the deal done if you're looking to buy or whatever. And then once you file 2 years of tax returns, if the rates are better at that time, go and refinance it. Use your tax returns and qualify for a conventional loan at that point. So this might be kind of a fixer for now. Maybe the rate's a little bit higher, but at least it accomplishes what you want to do. And then the long-term goal is to get out of it and get into a standard mortgage. So
that's an example of an exception, Nico, because, Dan's point, we also require 2 years self-employment. But when you look at the collection of that borrower, he's being almost punished because he got promoted to partner.
Yeah.
So what we did, Dan, is we took the last 12 months bank statements and cash flowed off of that. Again,
wow.
Great power. Cool. You might also see somebody bought, hey, I've been working at this restaurant for, forever. And I just bought it 18 months ago and I'm killing it. Okay, let us see the last 12 months bank statements. And oftentimes when you buy any business, the seller is disclosing the financials to you. So show us the cash flow from the previous seller for the prior 12 months. Makes sense.
Pretty cool. Yep. Pretty cool. I think somebody did ask for okay, let's go to you control it, Nico, because I'm going to screw it up.
Yeah, all good. So what is going to be a main credit score for like a non-QM, or what's going to be your most average?
Minimum,
I'm sorry. Yeah. Ooh. Can you hear me?
We lost you.
My bad. That's my first time.
Okay.
Based on product, our minimum FICO is around 600, 620.
Okay.
As we said, our average is really over 700. So it would depend on the product, why the score was low. All those things come into play. Dan, we do handle folks that had, housing events, whether it be short sales or foreclosures. We have less of a seasoning time than perhaps, Fannie or Freddie as well. A lot of that stuff can be one-off and isolated, and now things have been cleaned up for a year or two.
How about forbearances? Because there's a lot of people coming out of forbearance right now that are looking to refinance for whatever reason. And most guidelines, if you're looking to pull out cash with a normal loan, a conventional loan, you have to make minimally 6 payments after you come out of the forbearance agreement. And then you can do a cash out refinance, no matter what your credit score, no matter what your loan to value is. Do you guys have anything like that, or is it just
3 months? 3 months.
They have to make three. They have to make 3 payments.
Yes, clean out of forbearance. Yeah.
Okay.
Ideally, and I've seen it done with even 1 or 2. If they were clean prior to forbearance, they took whatever the program was, and then as soon as the program was over, they paid again. They didn't extend. They weren't delinquent before the program. Many people during a time frame, including myself, who's never missed a payment, received a call from my bank. Do you want to? And I chose not to, but many people did.
Yeah, the same thing. I actually, when it was going on, I wanted to be able to advise customers that would call in. So I just called my mortgage company just to inquire, how's it all work? They're like, well, you want in it? I'm like, no, I just wanted to see, is there any qualifications that need to be done? No, just call in. It's like, okay, that's pretty simple, but I didn't. Sometimes I think maybe I should have, because a lot of these companies are throwing all the deferred interest on the back end, interest free. So it's like, okay, but alrighty, I think we got another one, Nico.
Aziz, nice seeing you, sir. We'll talk to you after this video, brother. We actually might go non-QM route. So
with him,
all right. Yeah, we might have to talk with Jamie.
Perfect. 620, self-employed, less than 2 years. Danielle. I'm Dan too. But I don't know if that's the Dan that I've been speaking with down in Florida, but it might be the one. So again, what we're looking at is, I'll specifically tell you a project that I'm working on. We're working on trying to get a lot of foreign nationals the ability to finance their homes when they're coming to the U.S. to buy properties. And again, the other day, I think it was even yesterday, they said there's $59 billion worth of U.S. Real estate that was purchased by foreign nationals last year alone. So if you're a realtor out there, you're missing the boat of reaching out to foreign nationals to buy real estate in the U.S. Jamie has a product that actually will help us with the foreign nationals. And so there's products for foreign nationals, there's investor loans, there's bank statement loans, assets depletion loans, non-warrantable condos, condotels. If anybody else thinks of any other programs that they would at least want to run past Jamie at this time, you can be a mortgage advisor, you can be a realtor, you can be a consumer, anything out there. You can even work at a bank and just have some friends that need this program. Please feel free to ask. Otherwise, that is it for today. And again, I apologize for the mess up in our links for the previous video. We started this at 2:00, but for some reason the YouTube wouldn't work. So I don't know if we lost a lot of people there or not. But Jamie, I want to just thank you for coming on here. I don't think there's any more questions. Usually, like I said, we have a couple hundred people on here. I don't know if I messed it up for some reason, somehow with the YouTube links, but we did. So I'm going to have you on here again in the next month. If you don't mind, we can revisit this for those that missed this, but I will be posting this on the YouTube channel as well as a complete video, so that if anybody's out there watching, they can be able to grab this here. So in conclusion, I'll ask you to conclude it for us. I don't mean to put you on the spot, but conclude it for us just so people don't still continue to think, God, these are bad loans.
Sure. Yes, Dan, first of all, thanks to you and your crew for having me. I really appreciate it. It's always good to talk with you. I would say this to all the folks listening. These are good loans. Just because they don't fit every single box of a certain government agency does not mean they are bad loans. It certainly does not mean the borrowers trying to get those loans are bad credit risk or bad people. They perform wonderfully since non-QM has been back securitizing around 2015. There's not a lot of delinquency, if any at all. There's not a lot of repos, if any at all, Dan. Your 30 plus, like we say in the old days, it's almost non-existent.
That's amazing.
Yeah.
What he means by 30 plus is 30 days delinquent or more on their mortgage. Do you guys have statistics yet on the defaults?
I don't, because honestly, it's so new. There hasn't been a lot of actual defaults.
Okay. So I know they've been 3, 4, 5 years. So if people have gone through that, if somebody had a non-QM loan, were they able to request a forbearance on a non-QM loan? They
were not, Dan, and that's a great point, because the first test of the system, if you will, was a forbearance period, and we did well. And what we did in those times was we got close to the borrower. Was a lot of self-employed bank statement folks. And I was always impressed with the ingenuity of some of these folks, restaurant owners, who would say, listen, my revenue is down 20%, but my expenses are down 50%. I've got outside dining. I went to takeout. I'm doing, a music thing. I've got a family meal package. And it was impressive. It was nice to see that American, entrepreneurial spirit really in full effect. But it performed well during that, what I call COVID-1 period of early 2020. And, the testament to that is it's still going very well now. Nobody's pulled back. If anything, programs probably expanded a little bit since then. So I would say this to the folks on the phone, or listening or online. I showed my age with on the phone. If you're looking for a loan and you've been denied, just check with Dan and his team. There's a lot of great products out there. You may fit some of them. Common sense applies. If you've got good credit and you're a good borrower, you could probably get some help somewhere with this group.
Awesome. Well, again, Jamie, I want to thank you so much for joining us today. Sorry about the debacle. We'll have you on again soon. I guarantee it, because I'm going to get familiar with these programs. We're going to be sending you some business. I'll get acclimated with it. And then what I could do is come back and be a little more informative to the viewers and maybe ask you some questions that I just don't know. I don't know what I don't know yet, and you're there to educate me. So thank you so much for being here with us. Guys, thanks for joining us today. Sorry about the mishap on the technology, but I'll be back tomorrow with the Mortgage Minute, so you guys can check out where rates are going tomorrow and what the economy is doing. So thanks again, everybody, for being here. Thank you, Jamie, for taking time out of your day to visit us, and we will see you on Thursday. Take care, folks. Bye-bye.